individual stocks and bonds, mutual funds, index funds, ETFs, and REITs. If you've ever been confused as to what these things are, how they make money, and the differences between them, make sure you stick around because we're going to be introducing these investment vehicles in today's episode. Hey wealth builders, and welcome back to another episode of The Bemused. If you're new around here, my name is Akiva, and on this channel we make sense of all things money for the bewildered and confused young adult. So if you're ready to start taking charge of your finances, to live a life that you love, make sure you come join the squad by hitting that subscribe button and turning on the post notification bell so you never miss a single episode. This is the third video in our investing series that we have going on right now. So far we've covered what investing actually is, and we've defined a few critical terms that you need to understand before taking the plunge into investing. And so if you missed the first two and want to see them in order, I'll make sure I put a card up here so that you can watch it from the very beginning. And so in today's video, as I mentioned, we're going to be going into some different types of investment vehicles, some really popular ones. Investment vehicles are the products that you use to actually invest, and we're going to be talking about 6 of them in today's episode. So let's dive in. So let's start with individual stocks. So stocks, as we mentioned in our last video, are a type of equity investment. So very simply, when you buy a stock, you are buying ownership in a company. Now you can own stock in a private company or a public company, but typically when most people talk about stocks, we're referring to publicly traded companies like your Apples, your Googles, even your Beyond Meats. Public company stock is traded on a stock exchange, and there are several stock exchanges that exist across the world, but 2 of the largest ones are here in the US. We have the New York Stock Exchange, and then we have NASDAQ, which I actually never knew what NASDAQ really stood for before doing this video. And so just in case you're wondering, NASDAQ stands for the National Association of Securities Dealers Automated Quotation. Don't know who came up with that, maybe I can look that up later. Now you can buy and sell individual stocks easily through online brokerages like Vanguard or Fidelity or Robinhood, for example. However, most of these platforms will charge you a fee to do so. Some of these platforms like M1 Finance and Betterment, for example, also allow you to buy fractional shares. So say for example, you want to buy a share of Apple. Apple stock is currently trading around $200. The problem is all you have is $50 to invest. So what do? In that case, purchasing fractional shares would allow you to buy 1/4 share, or 0.25 shares of Apple. So you don't have to come up with the whole thing to buy a whole share. It's important to note that buying one individual stock is of course a really risky move because you're essentially putting all of your investment eggs into that one basket. And as we know, the price of a stock can go up and down at any moment in the day. So how do stocks even make money in the first place? And there are 2 ways. The first is through appreciation, and the second is through dividends. So let's start with appreciation. So stock prices move up and down and they fluctuate throughout the day because of supply and demand. So if more people want to buy a particular stock, that increases the demand on the stock and increases the price of the stock. And conversely, if more people want to sell a stock, the price of that stock is going to fall. So that's why whenever you see a controversial news article come out about a certain company or industry, the prices of those stocks tend to fall because nobody wants to own shares of a company that's in hot water at the moment, and therefore demand is falling. So some publicly traded companies also offer dividends. A dividend is essentially a company saying, thank you for owning our stock. So when they have profits at the end of the year, sometimes even if they don't have profits, they will issue dividends as a reward to their shareholders. Larger, more established companies with predictable profits are typically the type of companies that you'll see giving dividends on a regular basis. Dividends are actually decided and managed by that particular company's board of directors. Dividends can be issued in the form of cash or through stock, but the most popular way is a cash dividend. So you can use that cash dividend however you want. You can cash it out or you can reinvest it back into the same stock that issued the dividend and continue to grow your investments in that way. Now let's move on to individual bonds. Bonds, as we mentioned in a previous video, are a type of fixed income investment. And when you buy an individual bond, you are essentially lending your money to a company or the government, for example, and they are paying you back with interest. So you make money through bonds in 2 ways also, through the interest that you receive, and also bonds can actually appreciate in value as well. In general, when interest rates go down, the prices of bonds go up. And so if you bought a bond and interest rates decreased and the value of your bond is now greater, you could potentially sell your bond before it's matured at a profit. So if you want to buy an individual bond, you can go directly to that specific company or directly to the government. You can also buy individual bonds through an online brokerage account. However, this option does often come with some trading costs, so keep that in mind. Now let's dive into ETFs, mutual funds, and index funds. Now when I first started learning about investing, I know that I was super confused as to what the difference is between these three things. So I'm gonna break it down right now. So let's start with what they all have in common. So index funds, ETFs, and mutual funds are all pooled vehicles, meaning that they have a combination and collection of different types of investments and assets within one fund. So you can have a fund that's made up of all stocks, all pooled together, one that's made up of all bonds pooled together, and you can also have funds that are made up of investments that cross different asset classes. So say for example, you have $100 to invest. So instead of buying one individual stock for $20 over here, and then another stock for $30 over there, and then a bond for $50 over there, you can invest your $100 into one of these funds and gain exposure to tens, hundreds, if not thousands of different investments. So the primary benefit in investing in one of these vehicles versus an individual stock or individual bond or individual anything for that matter is diversification. Diversification means that you're reducing the volatility and the risk of your portfolio. By holding a variety of different investments through one of these pooled vehicles, you're lessening the risk in your portfolio because you're not putting all of your eggs into one basket. So if a fund holds 10 different positions and one company goes bust, you at least have the other 9 that might be performing well, and it mitigates that risk across the entire fund. So now let's get into a little bit of the differences between these three things. So an ETF or exchange traded fund is actually, like it says in the name, exchange traded. So it is actively traded every day just like an individual stock is on a stock exchange. So you can buy and sell throughout the day and the prices go up and down throughout the day. Most of these funds are passively managed, which means the goal is simply to perform according to that particular benchmark. And if you don't know what a benchmark is, go back over to the second video because we defined what a benchmark was in that video. The passive management approach that most ETFs take also most times results in lower fees for that fund. Now, mutual funds and ETFs have a couple of key differences. So unlike ETFs, mutual funds are not traded intraday. They are priced once a day at the end of every day. Also, most mutual funds are actively managed. So the goal is to try to outperform that asset class's benchmark. So to do that, a person or a team is often hired to manage the underlying investments and pick and choose them so that they can try to outperform the market. And that oftentimes results in higher fees for investing in mutual funds. And just like individual stocks, ETFs and mutual funds can pay dividends because they are made up, once again, of pooled investments. So they do have that underlying stock that's still paying out the dividends. So if a stock within one of those funds pays out a dividend, it also gets passed up to you because you are technically a shareholder of that company. So you might be wondering which one is better, a mutual fund or an ETF? And there really isn't one right answer. It really just depends on the goals that you have for your investment portfolio. If you think active management will help you get a higher return, then go for it. If you don't really care for that and you just want to perform how the rest of the market is performing according to the benchmark, then an ETF might be a better bet for you. But there really isn't one right answer. Now, index funds are actually a type of ETF or mutual fund. It isn't necessarily a separate vehicle all unto itself. The main tenet of an index fund is that an index fund is designed to track a benchmark or an index. So therefore, the majority of ETFs are also index funds because the goal is to try to perform according to the benchmark or the market. Now let's talk about REITs. REIT stands for Real Estate Investment Trust. A REIT is a company that owns, operates, or finances income-producing real estate. So this can be commercial real estate, it can be residential real estate, really all types of real estate can be included in a REIT. So REITs make money from the properties that they purchase by renting or leasing or selling them, and they pass on those profits to you as the investor. REITs allow you to buy shares in real estate portfolios that receive income from a variety of real estate properties. They're a low barrier entryway to getting started in real estate investing. So instead of having to save up a bunch of money to then buy a rental property and fix it all up and deal with the tenants and blah, 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 if you want exposure to the real estate market, you can do so through a REIT instead. So when learning about investing, I think it's also really important to understand how these things are actually taxed so that you know the repercussions of buying and selling different types of investments. In the next video in this series, we're going to be discussing how each of these investment vehicles that we just talked about, how they get taxed. Because of course, the US government doesn't give anybody a free lunch around here. So make sure you hit that subscribe button and turn on the notification bell so that you don't miss when those videos come out. If you're getting value out of this investing series, make sure you let us know in the comments below. But don't just stop there. Don't just keep the wealth to yourself. Share the knowledge with family and friends, other people who you know would be really interested in learning more about how to invest. Thanks for spending this time with me, and I'll see you in the next video.